Morning, everyone. Welcome back to Current Economy and Investment Insights. Today is December 7th, 2020, and I'm Ron Jankowski with Channel 4 in Palos Heights. We're going to give you the financial update from Paul at Ameriprise Financial. Paul is at his studio at his home so that we keep distance, so I'm going to let Paul take it from there, and when he's finished, I will give you an update as of this morning. Paul, it's all yours.
Will the markets once again look past near-term economic challenges? That's a question I've been getting a lot, and most likely, yes, in our view. In early spring, the stock market had already begun its recovery before the second quarter, and its economic plunge had even started. In retrospect, the divergence isn't that surprising, given that stock prices typically reflect the conditions investors expect in the future rather than the present. We believe it was appropriate to review that narrative again today. COVID-19 cases are surging in nearly every corner of the United States, as they have been in Europe and other places as well. States and local jurisdictions are starting to re-implement restrictions on certain businesses' activities as a result, and consumers appear to be returning to more cautious behavior as well. Most medical experts believe we are still early in the current surge. Additionally, consumers have been left to face this viral assault with little to no remaining fiscal stimulus support. As such, economic activity, particularly at the consumer level, is likely to wane over the next few months in our view. However modest, declines in the real consumer spending had already been factored into our real GDP estimates we provided for November and December. Further, the very positive recent news related to vaccines and treatments should provide solid support to investor sentiment through this period. We still believe another federal stimulus package to be very likely, but the size, timing, and specifics remains very uncertain. If the next round should arrive by mid-Q1, early part of next year, it would likely arrive just as vaccines are becoming more widely available and the consumer virus concerns are fading. Though we expect real consumer spending to contract modestly in November and December, Q4 real GDP should remain solidly positive. In our view, and our current estimate is a positive 3.4%, we entered the fourth quarter with strong momentum, particularly at the consumer level. Next week, retail sales for October are widely expected to post a strong month-over-month gain of 0.5%, and that estimate is according to Bloomberg consensus. That would equate to a year-over-year gain of better than 5%. The results are thought likely to have been boosted by Amazon's Prime Days, that's October 13th and 14th, an event that was matched by most of its competitors. A new look to year-end planning in 2020. At this time of year, you often hear advice to take steps before the end of the year to limit your tax liability. Yet 2020 is a unique year in a variety of ways. While many of the normal rules regarding managing income and timing deductions still apply, new provisions for 2020 have been implemented by the Coronavirus Aid, the Relief and Economic Security CARES Act, and that may impact your year-end tax planning. So consider any of these actions if any of these will make sense for you. And as always, talk to your tax advisor before you take any action. So number one, reconsider required distributions. Required minimum distributions from workplace retirement plans or IRAs are optional due to the CARES Act this year. If you haven't yet taken your RMD this year, you can let your money continue to grow. If you have taken your RMD, there is a 60-day window where you can redeposit those funds in your IRA and eliminate the claim to an RMD. As another option, if you have earned income from work, you may want to take all or part of the RMD for this year and invest all or some of the proceeds into a Roth IRA. This allows you to build up your Roth savings, which ultimately can qualify for tax-free distributions later in retirement and aren't subject to RMD rules. Something else to consider is to capitalize on your deductions. The standard deduction for 2020 is $12,400 for a single person and $24,800 for married couples filing a joint return. At that level, most people claim a standard deduction rather than itemizing deductions. In 2020, you can claim an additional $300 for cash contributions to qualified charities. Be sure to take advantage of that opportunity before the end of the year. This is a one-time deduction for those who don't itemize. Also consider taking early withdrawals if needed. So if your financial circumstances have been directly affected by COVID-19, such as a job loss, or you or others in your household have been diagnosed with the virus, you can tap to your retirement savings. If you have not yet reached the age of 59 and a half, you can do so without penalty if you qualify. But the early distributions must occur before the year end. The tax burden associated with these distributions can be spread out over 3 years. Also consider harvest investment gains or losses. Given the market's volatility this year, you may want to consider harvesting capital losses. This is accomplished by selling investments in a loss position and using those losses to offset gains you realize when selling other investments. Capital losses can also be used to reduce up to $3,000 of earned income in any given year. Finally, be prepared for changes. With an election here, there could be changes in the tax laws that might impact everything from tax brackets to the estate tax laws starting in 2021. This may be an additional consideration as you make your year-end plans, so be sure to consult with your financial advisor and tax advisor before finalizing your decisions. And I can't emphasize that last point enough. Before you take any action on anything reported on, please review that with your financial advisor and your tax advisor before you take any actions whatsoever. If you like additional information, feel free to contact me directly. I can be reached at 708-226-3412.
Thanks, Paul, for your update. And as I mentioned, Ameriprise had given us the information as of this morning's activity. U.S. stock index futures are slightly lower as investors wait for the coronavirus package to be approved as in Congress. Stocks in Europe are mostly lower on growing concerns over a no-deal Brexit. Global oil prices are lower as a continued surge in coronavirus cases forced a series of renewed lockdowns. And of course, that means people are not traveling and the reserves are starting to build up of oil. Shares of Eastman Kodak are sharply higher after the firm was cleared of wrongdoing in a $765 million federal loan. There was concern about wrongdoing, and apparently it has been cleared. As of this morning, the year-to-date notes on the S&P 500 is a plus 16%. The Dow Jones year-to-date is a plus 8%. The NASDAQ is a plus 40%. So everything is pretty stable. We'll see what happens this week. Stay with us. Paul is going to be back with a topic that he has come up with on your money. We'll be right back. And we're back with your money. And Paul Munico from Ameriprise Financial has a topic to share with most individuals that are either investments on short-term, long-term, or just small investors and need to know the information that he sometimes shares with them for guidance. And I'm going to let Paul take it from there. Paul, you got it.
Okay, today we're going to talk about the housing economy a bit, and specifically how surging home improvement spending is pretty indicative of some favorable recovery prospects. So let's dive into it. You know, one of the more frustrating experiences of consumer behavior is that oftentimes when you think it would be a good time to make a particular purchase, everyone else thinks the exact same thing too, thus making for short supply and higher prices. Now, this has been apparent in a number of categories this year, but none more so than the hot housing market we're in. Housing demand itself has boomed for various reasons, but now that we are all spending a lot more time in our living spaces, its shortcomings have become much more apparent. So as a result, more home improvement spending has surged. However, in many places, actual spending likely bellies market's demand due to very tight availability. If you're sought out to do some home remodeling or some other type of home improvements lately, you'll very likely know this firsthand, especially if you require a skilled trades person. After finding a contractor, the start date of your project is likely to be set for some time long into the future. And the same could be said for the products required, such as furniture and appliances. Now, such situations are frustrating, but they offer very positive implications for the path ahead. Simply put, the historical norm of needing to realign supply or bring it down to match lower levels of demand is usually a drag on recovery periods. But currently, the opposite is true in many sectors of the economy where supply needs to be ramped up to align with higher levels of demand. This ongoing situation should continue to bolster economic activity and thus recovery prospects as virus conditions will allow. That's just in our view. As always, we have to wait and see. Predictions are tough, but that's what we think at this point in time. And again, we'll wait and see how everything plays out. Okay, sticking with the housing market theme, for the second half of the show today, we're going to talk about what to expect if you plan to downsize your home. So if you are nearing or in retirement, you may be reconsidering your housing needs. Does your current home feel like it's too big for your needs? Will multi-level living be challenging later in life? Do you look at your current home as a source of retirement cash if you can sell it and move into something smaller? Downsizing is a logical consideration, but it is not a decision to be taken lightly. There are a variety of factors you need to consider before you lock into your decision. So number one, weigh the benefits against the downsides. So depending on the size of your existing home, shifting to a smaller living space is an adjustment. You'll still want sufficient room to comfortably conduct your everyday life. This can include entertaining guests and hosting overnight visitors in your house, such as children and/or grandchildren. You'll also want adequate storage and space for your kitchen, home office, and/or your workshop. Longer-term considerations include issues like reducing or eliminating the need to climb stairs, to get around in your home, or making it wheelchair accessible. Limiting outdoor maintenance requirements may be another factor. Think about your priorities and how a different sized home would meet those needs compared to your current accommodations. Now, of course, let's talk about the financial side. Many believe they will still, or they'll be able to bank a large amount of money from selling their existing large home by moving to a smaller, presumably less expensive one. Now, unfortunately, it may not always work out the way you think. So, depending on where you live, you may find that the market for larger homes is not as strong as you'd expect. At the same time, with many baby boomers considering the benefits of downsizing, the demand for smaller homes is high, and those homes may be more costly than you think. As you weigh your options, you may want to ask a real estate agent to help you not only in your search for a new home, but for a market analysis that will help you determine the value of your existing property. Other financial considerations include potential taxes if you generate a large gain on the sale of your existing home, so always check with your tax advisor to find out more information. Closing costs are an added expense that will come into play in your transactions and one that should not be taken lightly. Last but not least, of course, I'm going to say planning is important. Your living space is a core aspect of your life and becomes even more important in retirement since you may be spending more time there. Determining the right type of home and the appropriate location is not a decision to be taken lightly. Most importantly is to make a choice that suits your lifestyle and your retirement goals. The financial implications are an additional factor. So always, before you do anything, talk to your financial advisor about a plan and how it fits into your overall retirement plan. I always recommend speaking to a tax advisor before taking any action, and potentially maybe even speak with a lawyer before taking any action on buying and selling homes. As always, please feel free to use me as a source of information. If you're working with an advisor currently and you want a second opinion, or if you're not working with someone and you're looking for a primary opinion, feel free to give me a call directly. I can be reached at 708-226-3412.
And thank you, Paul, for that topic. We appreciate your efforts in your studio and sharing your input to Channel 4. For Paul Munichel at Ameriprise Financial, myself, Ron Jankowski with Channel 4, we wish you good investment day.